Hello everyone, welcome to chapter 6 of the Access Circle. Now, before we get into the details of this chapter, let's first of all talk about what this chapter is really about. And I want you to actually listen closely to this because this part right here, this chapter is where everything that you've learned so far in the previous chapters actually starts to come together. Okay? We've already covered topics like directional bias, context, and anticipation in earlier chapters. Those were basically the building blocks. But now this chapter, this one is going to be about execution, and execution is what ties all of them together. Okay, execution helps you in actually putting all of those building blocks into motion and creating entries with it and finding entries with it and actually executing in real time. Okay, now the thing is that you can have the cleanest directional bias, you can have the perfect market context in even the right market conditions, but if you can't execute it properly in real time in live market conditions, then none of that matters, you'll still lose. Okay, this is why I've made this chapter, and this is why this chapter is so significant. Now the way I would sum up execution in a few words is that execution is the moment where your preparation, your routines, your structural frameworks, your rules, and your discipline, all of them comes together in real time. Okay, execution is basically the bridge between theory, your analysis, and real time live market application, or you could say your entries. It acts as a bridge between those two elements. Now, this chapter, just as I told you, is about creating the procedural framework for execution so it's no longer random for you. And instead, you know and you understand exactly what to do, when to do it, and exactly why you are doing those things. Okay, now down below, we've got the different core components of the execution framework. First of all, we've got time frame selection, which basically involves defining the time frames that we'll be using for execution. Okay, after that we've got entry triggers, then entry confirmations, orders placement, and last but not least we've got trade management. Okay, these are the 5 core components of the execution framework. Now in the next few slides I'll be discussing each one of them in detail with examples. Okay, and by the time you are done with this chapter, by the end of this chapter, you will have a complete, a structured, a repeatable, and most importantly, a mechanical framework for execution. So first of all, we've got time frame selection, which is basically about classifying the time frames that we'll be using for execution. Now remember, the actual entry tracking or the actual process of finding entries and taking entries or executing trades is actually done on a single time frame, which is the 15-minute time frame. But the reason I've written down 2 time frames here is because we're going to be executing trades and framing those trades around the context or the market context that we would have established on the 4-hour. That's why I've written down 2 time frames. Okay, now you know, for establishing a market context or developing a market context, we use the 4-hour time frame. Okay, which basically involves finding appropriate and the correct key levels for the day and finding candle ranges on the 4-hour. Okay, so for context, we will be using the 4-hour, and we've already discussed this in the previous chapter. And then to frame trades around that particular market context, we will be using the 15-minute time frame. Okay, so don't confuse this with using 2 time frames for finding entries or executions, because that's not true at all. The reason I've written down 2 time frames here is because one is going to be for establishing a context, and then the other one, which is the 15-minute for us, will be used for framing entries around that context. Okay, now let's talk about the second component, which is entry triggers. Now, entry triggers are exactly what the name suggests. They are the thing or the trigger that puts you into active monitoring mode. And what I mean by that is that when an entry trigger appears or when it happens, that's when you shift from passively watching price to actively monitoring price action and actively paying attention to price action on the 15-minute time frame. And until this moment, until an entry trigger appears, you do nothing. Okay, you literally do nothing until an entry trigger appears on the 15-minute time frame. Okay, until an entry trigger appears, you shouldn't try to force price action. You shouldn't try to over analyze every candle, and most importantly, you shouldn't try to create fake narratives just to justify taking trades for the sake of taking trades. Okay, instead what you should do is just sit back, do whatever you're doing, and just wait for price to hit the key levels or purge the candle ranges or the CRT that you've already identified on the contextual time frame, which is the 4 hour. And only when it does that, that's when you actually start paying attention, and that's when you move into the third component, which is entry confirmation. Okay, that's when you actively monitor the charts and look for entry confirmations. Now, the reason this part is so important is because this is also where most of you mess up. Instead of waiting, you start anticipating things that do not exist. You convince yourself that there is a setup when there isn't. Okay, instead of waiting patiently, you start seeing random candles as candle ranges or CRT. You start seeing a random candle and you treat it as a valid CRT even though there's no real context behind it. And that's where the damage happens. Okay, that's how you execute and take invalid trades and force invalid trades, and then you lose them. Okay, this is why this part is so important. Now, the whole idea here is that you only start actively watching price only when an entry trigger appears. And until that point, you do nothing. Okay? When an entry trigger, like a key level reaction or a liquidity purge, happens, that's when you open the 15-minute time frame and start looking for your entry confirmation. And that's when you move to the third component, which is entry confirmation, or basically looking for entries. Okay, now down below right here you can see the three different types of entry triggers. Okay, these are the three types of entry triggers in my execution model. First of all, we've got key level reaction. Now this is straightforward. Okay, in the contextual layer, you would have already marked a key level on the 4 hour time frame. Okay, based on your bias and based on a proper market context. Now your job after that is just to wait for price to approach that key level and react to it. And that's a type of entry trigger. Only when price reacts to that key level and tests it at a key time, that's when you move to the next component, which is entry confirmation. And until that happens, you do nothing and you just wait patiently for price. Okay, and remember, all of that will be true only if it happens at a key time, because it has to be aligned with not only your context and bias, but also with the timing of it. Now, the second type of entry trigger that we have is a liquidity purge. Now, this one is also pretty straightforward. It involves waiting for a purge around the CRT or the candle range that you would have selected on the 4 hour time frame when establishing a market context. Okay, and then after that we've got the third type of entry trigger, which is NSMT divergence. And this is basically when you have two correlated assets and one of the correlated assets does not offer you a key level reaction or a liquidity purge, but the other one does. And in that case, that also becomes your indirect confirmation, and that becomes your entry trigger. And when that happens, you then start actively watching price action and paying attention to it and move to the third component, which is entry confirmation. Okay, now that we've discussed all of this, let me give you some live examples of it, and let me show you why this component is so important and why does it hold so much significance. So we've got this Euro USD chart right here. First of all, I'll break down a trade for you, and then using that trade, I'll show you and I'll explain to you the significance of entry triggers and how entry triggers help me with my execution process, and how it helped me make much more informed decisions about finding entries and waiting for entries. Okay. First of all, I'll break down this price action for you and I'll show you exactly what my thought process was when determining the directional bias for the day, or for the day that this trade was taken on. So first of all, right here, you can see that we've got this macro dealing range. Now for the past 2 months, after we had this structural shift, I was expecting price to reach the discount region of this macro dealing range, and my expectation for price was to take out this candle range low. That was my target for the past 2 months. Now this month what happened is that instead of taking out this low, we had an SMT divergence with both DXY and GU. Okay, we reached the discount region of the macro dealing range, but instead of taking out this low, we had an SMT divergence. Okay, now because of this SMT divergence and because this candle closed higher inside this candle, my expectation and my anticipation for price turned bullish. And now based on this price action, we also have this candle range right here. Now I chose this as my candle range, as my CRT, and this week, the trade that I took within this week, during this week, my directional bias was bullish and my drawn liquidity for the week was this CRT high, and I expected price to reach that CRT high this week. Okay, now let's go down to the daily time frame and let's see what we have there. Again, we have the SMT divergence. After that SMT divergence, we also had this CSD, or this structural shift, or you could say a change in the state of delivery, which led to the formation of this order block. What price did is that on Thursday, it tested this order block and expanded higher. Now on the Tuesday of this week, since we had already tested this order block, this key level, and along with that, we had already formed the low of the week at this inverse fair value gap. Okay, we had formed the low of the week on Monday at this key level, and since we had already done those two things, that had already established the low of the week and it had established the weekly structure. And based on that, I expected Tuesday to be a true expansion. Since the drawn liquidity was higher and the directional bias was bullish, the only thing that was now left for me to determine was to figure out whether we're going to have a true expansion on Tuesday or not. And since we had already established the low of the week on Monday after price reacted to the inverse fair value gap, and due to that weekly structure, my expectation for Tuesday was for it to have a true expansion higher. That was my expectation for Tuesday. So now let's go down to the 4-hour time frame and let's see how I established a market context there. The drawn liquidity for this week was this high. Let me remove all of this, and this is the daily order block. Right here you can see that after we had the SMT divergence on the weekly time frame with DXY and GU, we then had this expansion higher. Okay, also within that expansion right here you can see that on Friday we tested the daily order block and had another expansion. And then after that on Monday, we just consolidated and formed a range and basically established the low of the week. Okay. And then on Tuesday, right here on the 4-hour time frame, my first objective was to define or establish a proper market context. Now for that, first of all, I had to define the dealing range on Tuesday that price was within. The dealing range. Then the next step was to identify an appropriate key level within that dealing range. And then last but not least, a valid and a relevant and an appropriate CRT or a candle range. Okay, now since we had already tested the higher time frame daily order block on Friday, and then we had this expansion higher, that expansion swing became my dealing range. And right here we have the premium region and the discount region of the dealing range. Now within the discount region of this dealing range, we have this key level, this discount key level in the form of this order block. I took this discount order block as my key level within the dealing range, and now the only thing that I had left was to find a candle range. And since I was already expecting an expansion higher right here within this dealing range, I took this candle as a candle range because it was just above this key level. Okay, for Tuesday I took this candle, this 9 p.m. candle, as a CRT, and I expected price to first of all take out this CRT, react to this key level at a key time, and then from that point on, my anticipation for price was to have an expansion higher. Okay, and right here you can see that by this point I had established the market context for Tuesday, and within that dealing range I had chosen this discount order block as my appropriate key level, and I also had this candle as my CRT. Now the only thing that now was left for me was to wait for an entry trigger to form or appear, and until that entry trigger appeared, my objective was to just wait for price and do nothing. Okay, and within this scenario, within this context, the first entry trigger that I had in mind was a liquidity purge below this candle range, and second, the key level reaction of this discount order block. Okay, I waited patiently for either of these or both of these entry trigger to form or happen. Okay, my objective in this scenario was to wait for either of these or both of these entry triggers to happen before moving into the third component. Okay, and similarly, even for you in this scenario, your objective should have been to just wait for an entry trigger to form before looking for entries or before looking for trades. Okay, when all of this was playing out, instead of forcing invalid trades or instead of justifying trades, your objective should have been just to wait for the entry triggers to form or happen or appear. Okay, now till this point, most people are usually right. They are usually correct. They correctly identify the appropriate dealing ranges and the key levels and the CRTs or the candle ranges, meaning they correctly establish the market context on the 4-hour. But after this point on, that's when they go wrong. That's when they go downhill. And that is because instead of waiting for these entry triggers, instead of waiting for price to purge below the candle range and test the key level before looking for entries, what they end up doing is that they start feeling FOMO, they start feeling greedy, they start feeling afraid. And what I mean by that is that, let's say price is playing out right here. Now instead of waiting for price to purge below this candle and test this key level, what they end up doing is that they incorrectly start justifying random candles as key levels and candle ranges, even though there's no proper context behind it. For example, in this case, they may take this random candle as an order block instead of waiting for the correct order block to be tested, and they may start taking trades off of it, thinking if they don't take a trade, then they're going to miss out on profits, miss out on this expansion, miss out on this move, and obviously that never ends up working. Or maybe in this example, some of them may take this candle as an invalid CRT or start taking trades off of it because of FOMO, or because they can't wait for the correct entry triggers or the correct candle ranges, or maybe because they start incorrectly thinking that if they don't take this bearish move, they're going to miss out on profits. And because of all of this false logic and false justification and false narratives, they lose trades. But if they had just waited for price to approach this key level, purge this candle range, if they had just done that instead of doing all of this and set alerts and alarms at these levels, then that would have been the correct approach, then that would have been enough. But most people end up justifying invalid trades or invalid or false narratives. Okay, now in this case, my obviously I waited for the entry triggers, so I just waited for price. And right here you can see that now that price had purged the candle range and tested the key level, the discount key level. Only from this point on, I then moved to the 15-minute time frame and started looking for entry confirmations in the form of an order block formation. Okay, that's the correct approach right here. After establishing a market context, you should just wait for the entry triggers to happen or to form or to appear. And until that happens, you absolutely do nothing. Okay, you do nothing until an entry trigger appears. Now we move on to probably one of the most important components of execution, which is entry confirmation. Now this is where things get a bit real. Okay, this is basically where you take your entry, you confirm your entry, and then you execute it using MetaTrader or maybe any other trading station or trading platform that you're using, maybe like CTrader or any other one. Okay, now in simple words, entry confirmation is basically your entry model, your entry setup, or you could say your entry pattern that confirms your entry or that confirms your trade and tells you that now you can enter the trade, execute it, and write the daily range expansion. Okay, by this point, what I mean by that is that by this point, you've already established the higher time frame directional bias. You've already determined or established the market context on the 4-hour. And along with that, the entry triggers has also gone off, meaning price has now given you a key level reaction and a proper liquidity purge. Now, the only thing that is left for you is now to confirm your trade, and that happens in this component right here. Okay, this component right here is basically like the final green light for you. Okay, this is where you confirm your entry. Simple as that. Now, entry confirmation consists of two main components. First of all, the actual entry pattern, which is basically the technical aspect of it, which offers you the technical structure. And then we've got timing, basically when it happens, which is obviously just as important. Okay, now let's discuss each one of them in detail. First of all, we've got the entry pattern. Now there are three entry patterns or entry setups that you can use, but let me be straight with you. My personal go-to or my personal entry setup or entry pattern or entry model, whatever you may want to call it, is the order block formation one. Okay, that's the one that I trust the most, and that's the one that I built my rules around and my execution framework around. Okay, and the reason for that is that this one gives me the most clarity and the most confidence in my execution because of its mechanicality. Okay, order block formation is the one that I personally use. Now, apart from that, other valid confirmation patterns include fair value gap formation, which is when a fair value gap is formed after an entry trigger like a key level reaction or a liquidity purge, or you could use a market structure shift. But again, for me personally, I use the order block formation for confirming my entries. And then we've got the second half of confirmation, which is the timing. Now for me, timing is everything. Okay, because you don't just want a clean pattern or a clean setup, you also want that pattern or that setup to show up at the right time. Okay, this is why it is important. Now for me, I use three time-based filters to personally time my entries or time my executions. First of all, I use key times or key macros like the New York Open, London Open, or key times or key macros like the 3 a.m. or 9 a.m. to filter my trades. And apart from that, I use time ranges and opening and closing hours of the 4 hour candles. Now, I'll be honest with you, I'm going to keep some of these a bit ambiguous on purpose, specifically the timed ranges and the opening and closing hours of the 4 hour candles. These are personal discoveries of mine, and they've made a huge difference for me in filtering good setups from traps or manipulations. Okay, but they're not something I'm fully disclosing in this framework, at least not yet. Okay, and the reason for that is that because they are a bit more nuanced and I'm still refining how I teach them. But I will say this, these timing filters have helped me avoid a very common trap. Okay, and this trap is the one where price forms a perfect order block at a key time, and then you enter it, and what usually happens, it takes out your stop loss, and then it goes and forms another order block before making the actual move. You've probably seen this happen a lot of times, but if you use proper timing, time ranges, and the other filters, uh, those filters can help you avoid these sort of situations and these sort of cases. The next component that we have is order placement. Now, this component is a bit formal one. It doesn't involve that much nuance. It just basically acts as a bridge between your entry confirmation and your actual trade. Okay, this step translate your entry confirmation into an actual trade with a predefined risk profile. Okay, order placement, this component right here, deals with where you set your entry, your stop loss, and your take profit levels, and what is the logic behind those decisions. Now, I'm going to keep it simple and straightforward here. So for me, within the Access system, my approach is simple. I personally use order block formation is my confirmation model or my entry confirmation pattern. And that means once I see my order block confirmed after a valid entry trigger, I follow these clear set of rules. So for entry, it's always at the open of the order block. The stop loss is always at the low of the order block if I'm going to long, or at the high of the order block if I'm going to short. And then the take profit level is always set at a 3R target. Okay, I never change this. It's always set at 3R. Okay, and these are the protocols that I've refined through years of data, and it not only gives me consistent risk, but this approach right here is very mechanical. And due to that, whenever I'm executing live, I never hesitate or second guess these decisions or these protocols. Okay, now regarding the other approaches, if you want to use the fair value gap formation or the other one, then for those approaches, the order placement will follow a completely different logic. Okay, and then we've got the fifth component. It's not fourth, it's actually the fifth, which is trade management. Now this one is pretty simple. Trade management is everything that happens after the trade is executed or after the order is placed. Okay, and it's about protecting capital, locking profits, and adapting to market conditions without emotional interference or without letting emotions interfere. Now, the different key elements of trade management are the following. First of all, we've got scaling, which involves scaling into trades or scaling out of trades based on confirmations or based on market conditions. Second, we've got stop loss placement, which means whether your stop loss is always fixed or you trail it based on confirmations or based on certain protocols. Okay. We've got target placement, which means whether your target or your risk to reward ratio is fixed or is it dynamic, is it based on the drawn liquidity or based on any other protocols. Okay, and then we've got holding versus closing early based on market conditions. Now we've got all of these different elements, but within the access system, my personal approach is simple. I rarely ever, if not never, move my stop loss, which means I never move it. My stop loss is always fixed. Okay. Some people use a trailing stop loss, meaning they trail their stop loss to break even after a certain period of price action, or after a certain risk reward is reached. But for me, the stop loss is always fixed at the high or the low of the order block, and I never move it until either the take profit level is executed or the stop loss is taken out. Okay. And similarly with the take profit levels or my target, I never move my target. It's always fixed at 3R. Okay, so I don't close my trades at 2.5R or 2R. I always close it at 3R, fixed 3R. Okay, I never move it. And again, I never scale in and out of trades. And the reason I have made my approach so simple even for this trade management part is I want to make it and keep it as mechanical and as simple as possible. And you've seen it time to time that it has worked out perfectly for me. Okay, I could have easily added these elements to it, but the reason I've kept it simple is this right here, is so that it's mechanical and it's consistent and I can follow it easily without letting my emotions interfere. And this approach and this style right here, I've made it in such a way that it's aligned with the way how I think, it's aligned with the way how I behave. Okay, it's perfectly suited to my psychology and my mindset. Okay, what I found out through the years and through taking thousands, if not hundreds of thousands of trades over the years, I found out that I always end up micromanaging my trades if I look at price. And that's why, to cope with that problem, to avoid that problem, to be much more efficient, I've designed my trade management style in a way that is as simple as it could be, so that it involves little to no management of trades or managing your trades. Now, for you, your situation or your whole case could be different. Okay, you could have a complete opposite psychology to mine, and then it's up to you to determine what sort of style suits your um, mental makeup the best. Okay, that's up to you, and you could use these different elements within trade management to make up or to design or to build your own style of managing trades. So now let me end this chapter with this trade breakdown that I had started earlier. I'm gonna start off where we left earlier. So I talked about, I showed you how I established a market context in the form of this key level and this candle range. Then after that, I waited for entry triggers to occur, and the entry triggers that I had here was first of all a liquidity purge below this candle range, this CRT, and this key level reaction. And now that we have those two entry triggers, the next thing that I now need to do is to now actively monitor price action on the 15-minute time frame and wait for an entry confirmation in the form of an order block being formed. Okay, so from this point, I'll now then move on to the 15-minute time frame. Okay, and on the 15-minute time frame, my objective would now be to look for or wait for my entry to be confirmed in the form of an order block confirmation. So right here, this is the candle range low. This is the key level. You can see we've tested it. We've tested the key level. We've taken out the candle range. And now the next step is to wait for my entry to be confirmed in the form of an order block being formed. And in this example right here, we've got this candle which took out and which purged liquidity below the candle range low, which also tested the key level. And now I'll wait for this candle to be engulfed in the form of price closing above it. And once price closes above it, I'll use that as my order block and take an entry there. And right here you can see that now that we've closed above this candle and we formed this order block, my entry has now been confirmed. So now I will place my orders here, and the protocols are that I will put my entry at the high of the order block, okay, which is this high. I will place my stop loss at the low of the order block if I'm taking a long. So this is a long trade, so I'll take the put the stop loss at the low, and I'll put my target at fixed 3R, okay, at fixed 3R. And this right here is exactly the trade that I had executed on Tuesday. And right here you can see that we then eventually reached the target, and I closed the trade with 3R profits.